Hi there traders, in this week's video we're going to be covering the topic of what is the best time frame to trade off, because it's a question that's getting asked quite a lot, so I want to get that addressed and talk you through the various options you have as a trader and to encourage you to find and discover the best time frame that works for you, because there are lots of very good time frames to trade from. What's going to work best for you is finding a match between the time frame you trade off and your trading approach, and that will come into one of three really brackets of trading styles, which we'll talk through in due course. But firstly, what is a time frame? Let's talk through that first and foremost. Now, I'm looking here at the MT4 charts because MT4 charts are the most common, and no doubt the majority of the people watching this video are using MT4 charts. Now, you'll notice at the top here we have something called M1, M5, M15, M13, H1, H4, D1, W1, M1. These are the most common time frames that you can observe, do your analysis and trade from. Now, a time frame is simply the time frame that a candle or the price action within that candle is open between. So from when it opens to when it closes. So if you're looking at a daily chart like we're looking at now, a new candle would open at 10 o'clock at night, GMT or London time, and it wouldn't close until 24 hours later, a full day. And that will be what you see represented in the form of a full candle. So when a candle has physically closed and you're looking at the daily time frame, you can see 24 hours worth of price movements. Now you can relate that same approach but onto different time frames. So for example, if we looked at the 4-hour chart, each candle is simply representing the price movements up and down between a 4-hour period. So for example, opens at 12 o'clock, closes at 4. Next candle opens at 4, closes at 8, etc, etc. And the same would apply to the hourly, the 30-minute, the weekly, the monthly. So we can go from a higher time frame or a longer time period that the candle is open from. So that's the monthly. So a candle is open for a month's worth of trading days, so 20 trading days a week, 5 trading days a day, 24 hours, and so on and so forth. So those are the higher time frames, all the way down to minute 1, which is really the lowest time frame you'll be observing, and that's really where each candle is only open for 60 seconds. So as you'll by the nature of its by the very nature of the chart, the higher the time frame you're on, the slower it'll appear. As you go down the lower time frames, it will appear much faster because the candles are opening and closing over a much shorter time period. Now, that explains what they are, but the question is asked is, or commonly asked is, what is the best time frame to trade off? Now, it's a difficult one to answer because it's hard to just give you the holy grail and say this time frame is the best, because every trader is different. Every trader is going to have a different approach to the markets. Now, you can really bracket traders into 3 different categories or approaches to the market. You've got your end of day traders, which will look to trade the daily charts and hold a position for maybe 1 to 2 weeks, so are more of a longer term horizon trader. Then you've got your intraday traders that will trade during the most liquid trading sessions, which is normally between the European session and the US session, which is around about 7 o'clock GMT or London time through to 4 p.m. London time as well. That's when the markets are moving the most. It's when they're the most liquid. That's mainly because you've got the 2 major players. You've got the Europeans, the big banks of Europe and London, and you've also got the big New York banks as well, all trading at the same time. So there's lots of movements that take place, and that's what you call an intraday trader. So from 7 a.m. to 4 p.m. London time. So that's a day trader where you'll be looking to take a few more trades and looking at some lower time frames to try and give you a few more opportunities. Now, the higher time frame, the daily end of day trader, you're a lower frequency trader, but you hold positions for much longer. As an intraday trader, generally you're holding positions from within the same day through to a few days. So you're a more medium-term horizon trader, and so the lower time frames become more optimum. And then you've got news-based traders. So traders that will simply trade off the back of the news, and this is when you get the markets moving very fast and ferociously, and this is where you need to go down to a much lower time frame to try and almost scalp the market for a few pips in a very short time period. Now, I've traded all 3 types in my trading journey. I started initially when I was learning to trade with the end of day, the slow, steady daily charts, where I was an end of day trader trading around my marketing role. And that was great because it got me involved in the markets without too much time pressure. It was slow and steady. I could do my analysis with lots of time and not being forced to take a trade. That was great because that enabled me to learn my skills and become more efficient with the whole process of trading. And then eventually I moved to trading the intraday markets, and that was mainly because I was starting to do well end of day and then got the opportunity to work full time as a trader and started to look at the smaller time frames where I was trading between 7 and 4 p.m. looking for a few more opportunities than I perhaps got on the higher time frames when I was just trading around my 9 to 5 job. And then I've also traded news announcements as well, and to this day I often trade news announcements. Whenever there's a big news announcement that gives me a really one-directional move, I will use the much lower time frames to just get in and out quite quickly to almost scalp a few pips. So I've traded all three, and that's really the time frame that I have chosen throughout my journey has always been specific to my approach. I used the daily charts initially because that was more accommodative of my marketing role that I was doing at the time. It enabled me to trade around my marketing role and was much more flexible there. When I became full-time and had more availability, I could trade during the day, of which I went down to the medium-term time frames. And then now, because I'm a full-time trader, I'm also listening to the news every single day, and I can take news-based opportunities, of which I use the lower time frames. So each comes down to you as an individual, your own trading approach, your own trading style, and getting a fit between the two, because if you get a conflict between the two, trading will become very, very hard and it won't be sustainable. I know traders that are trying to dip in and out while they're at work trying to do another job, trying to trade off the hourly chart intraday, and they're getting headaches and they're getting panicked and they're getting emotional, and it's just a massive conflict between what they're trying to do with their day job and trading. What they should be doing is concentrating on end of day when they can approach the markets with the time that it deserves, not trying to force it in between meetings whilst at work. So it's really, really important that you get a good synergy with your trading approach and the time frame you trade off. That will make the time frame best for you specifically on a bespoke basis. So let's just go through those time frames. So this is the Kiwi dollar on the daily time frame. So every candle that you see, green or red, represents the movement of price of the Kiwi dollar exchange rate between 24 hours. This is where I started when I was doing my marketing job, and I needed to do some trading in the evening around that job. And it's great because it means there's no time pressures. It's nice and slow, it's nice and steady, so it does have its benefits. The only downside is it's limiting your opportunities because it's much slower and steadier. However, you can still generate some fantastic returns because the moves in pips are much greater because each candle generally is much, much larger. On average, 150 pips depending on the currency pair that you're trading per candle. So there's pros and cons to the daily chart, but I would recommend and suggest to you guys that are working full time that you end of day trade off the daily charts because it's more accommodative of your other commitments. Once you've got some track record on the daily chart, then yes, you can start to look at moving to the lower time frames, but that will become specific to you having more time available to trade during the intraday session. In terms of intraday trading, so between 7 a.m. and 4 p.m., I have a preference of the hourly chart. No particular reason for that. Is it just I find it much cleaner and crisper in terms of its movements. So that obviously has its benefits in regards to my technical analysis. So in terms of finding horizontal levels of support or resistance, looking at nice cycles, higher highs and higher lows, confirming the trend, looking for key buy zones or sell zones. I find it a really, really nice clean chart to trade off. So the hourly chart and sometimes the 4-hourly chart are really nice time frames that I personally use during the intraday session when I'm day trading. Also, on occasions I use the 30-minute chart, but the majority of my trades will happen on the 60-minute chart when I'm trading the day session, which is 7 a.m. to 4 p.m. London time. And then finally is news-based trading, which I do on occasions. There was a trade that I took this week. It was a news-based trade. It was based on the New Zealand dollar. I was looking to sell it off the back of the New Zealand Central Bank cutting interest rates. So I'm not going to go into the detail of why it did what it did, but essentially when you cut a interest rate in a nation, it's bad for the local currency. So when this happened, and it was a surprise and it was a shock, it caught the market out. We had a massive sell-off. So the RBNZ, the Central Bank of New Zealand, came out 10 p.m. Last Wednesday, and said we're cutting interest rates. That's bad for the New Zealand dollar. So the New Zealand dollar sold off against most other currency pairs, but I paired it against the US dollar because the US dollar is heading towards a rate hike, which is positive for the local currency. So we've got negative sentiment on the Kiwi, positive sentiment on the US dollar, so it was looking to sell Kiwi dollar. But because it was such a ferocious and quick move, I wasn't looking at the higher time frame because I'd have missed the opportunity. I was looking at the lower time frame, so I used the 5-minute chart on this occasion. So it popped back up, having had a massive move down, it popped back up, and the trade that I took was at 7080, or sold Kiwi dollar at 7080, and really just took a small scalp from it. I think it was about 20 pips, but I was able to do that because I was looking at a much lower time frame, a more intimate view of the price action. If I'd have looked at an hourly chart or a daily chart, I wouldn't have seen those efficient opportunities to enter the market when the price action was moving so ferociously. So really that just sums up the various time frames that you can use as a trader. There are many time frames out there, but it all comes down to finding a synergy between the time frame you trade off and your trading style. So understand who you are as a trader. Are you end of day trading around your job? Focus on the higher time frames, the daily chart. If you've got a bit more time available and you can trade during the intraday session, then look at some lower time frames. So the hourly chart, the 4-hour chart are normally very nice and clean and crisp in their movements for you to then be able to look at your technical analysis to combine with your fundamental analysis to find those really nice opportunities during the day. You will get a few more opportunities on the lower time frames than you will on the higher time frames, but remember there's some pros and cons to each time frame. Obviously the lower time frames you're having to spend more time at your screen, which sometimes is good but sometimes isn't ideal if you've got other things to do. End of day trading, you can set and forget, leave your trade alone for 24 hours and come back to see what's happened. And then finally, if you are getting to the point now where you've got lots of experience and you're starting to build up a good sound fundamental appreciation and understand the new style of trading, then you can look to get down onto the lower time frames. But it's really important to know that you need to trade the right news and the right currency pairs. So you can't just trade every single news announcement on the 5-minute chart. That just won't work. The reason why I chose the Kiwi dollar was because of the huge news announcement from New Zealand, which was a shock and a surprise, and there was a high probability that it was only going to go in one direction, and that was where I used the 5-minute chart, the lower time frame, to get a more intimate view of the price action to give me that ability to scalp some pips from the trade. So there's pros and cons to each and every single one, but hopefully that clarifies not only what a time frame is, but the various options to you and how to find the best time frame to trade off for you specifically. As ever, please feel free to email me if you want any more clarification on that, or if you are interested in the news-based trading or the lower time frame trading, then obviously there's my trade alert service that you can sign up to via the website. And again, if you are interested in some more hand-holding in terms of one-to-one coaching, that is also available as well. So I'm going to wrap up there, leave you to enjoy the rest of your day, and I'll speak to you on the next video. All the very best.